So again, this is a bearish framework. And the idea here is you're looking at a daily chart and you're looking for a daily swing trade. So you notice we have relative equal lows here. The market's bearish. We're expecting prices to dig deeper on the daily chart, attack the sell side here, and advance and accelerate maybe into this area here. So that's your framework for the daily chart. Specifically keying up on the return back into this fair value gap from this candle's low and this candle's high. We trade back up into that. We would expect the market to start to break down on the next day, and we would look for, since it's going to be a daily swing trade, we're going to be utilizing the 4-hour chart. So on the 4-hour chart, we can see zeroing in on the next day after this candle here. This high is here, but this candle's high here is here. It breaks down, we trade back up in. This is the 3rd of January. So we have bearish order block here, hits it perfectly. And we have all this SIBI here. Now it doesn't look like a SIBI because it's a 4-hour chart, but if you look at this entire decline here, all of this is a sell side imbalance, buy side inefficiency, and trading back up into a bearish order block, which is also an optimal trade entry. So we have high, low, retracement back in, optimal trade entry, and then we have a bearish order block here. So this candle here opens up, we trade back up into that right there. That would be your entry. Your stop would have to be above the rejection block and or above consequent encroachment of this candle's wick. Okay, that's where you'd put a stop. And you'd expect these relative equal lows to be traded through and accelerate through it and then reach down into the old low, which is over here. Okay, in the 4-hour chart on that bond market, and you'll see it delivers just like this. Okay, so I know some of you were emailing me, can you just give me a framework that makes sense on a little bit higher time frame? I don't like all these intraday. Okay, well here it is. It's very simple. You're just looking at the logic with a lot less moving parts. Now you can refine this and get it down to a very much more refined entry point, but it requires, again, time of day and the kill zone ideas. Okay, like the 7 o'clock in the morning to 10 o'clock in the morning New York kill zone. Why? Because it's the bond market, and bonds are very, very busy between 7 o'clock and 10. So, and very, very busy around 7:30 to 8:30. So if you are looking to be a bond trader, look at the 3 bonds that I teach you to use, the 5, the 10, and the 30-year, and look at that bond triad, the interest rate triad, and start looking for potentially SMT divergence in all of this turning point here. You want to compare the highs and start looking for that as a potential SMT divergence to support this idea here. And then once you put the trade on, you just let it rip. You don't try to monkey around with it too much. Leave the stop at your entry and then wait for these lows to break, move it to break even, and then maybe if you have enough to take something off with a partial, then do that. But you don't want to do too much with a swing trade, because moving your stop too aggressive, too fast is one of the easiest ways to get knocked out of the marketplace. And then once it starts moving in your favor again, chances are you probably don't have the experience to have gotten back in to that trade, and it's very frustrating. So if you're going to put the trade on, use the logic you used when you put the trade on initially, and just let it run. Okay, and just try to reduce the stop without trying to capture a profit. That's one of the really important things about swing trading, is try not to feel like you have to lock something in. It's more about removing the risk and reducing the risk, and then letting it try to reach towards your objective, which makes it very difficult for me personally as a trading approach. That's why I don't submit myself to this, because in the time period of each one of these individual 4-hour candles, I could find dozens of trades in all of this. So when I say things like that, it sounds like I'm trying to convince you not to be a swing trader, when it's not the case. I'm just showing you from my personal perspective why it doesn't fit me from a personality stance. My mind's back and forth 1,000 different times inside of 5 minutes. So let alone holding on to it for days, which is what you see here. This is several days of movement. And then eventually, if you look at the daily chart, we run right through this really nice and pretty deep too. So it's a couple $1,000s per contract from that entry there, getting a run below here. And this is something that you've been taught. Like, this is right out of core content. It's something that you expect to find. And if I was to tell you this was not a daily chart and say it was a 15-minute time frame, you would expect this entry here to sell off, right? It's a fair value gap and reach for these relative equal lows on a 15-minute time frame, if that's what this is, but it's not. It's a daily chart of the bond market. We run through it and it creates a short-term low here. It breaks market structure there. So now you know that this rally here, expect that to be a suspect rally. Then when it starts to break lower, you have another double confirmation. We have a swing low here, another swing low broken. So we have a larger swing. See how many times you have to wait for these types of events? The point is I can't bring myself to sit still and submit to this. In the lower time frame, 1 and 5 minute chart, there is a setup every single trading day. That does not mean your setup is going to occur every single trading day, though. Let me say it again, because it probably went over your head. Every single trading day, the 1 minute and 5 minute chart is going to give you a setup that you can clearly understand based on the things I teach in this core content. But it does not mean that every single day, your personal favorite setup and framework is going to provide that for you every single day. There's going to be something that you recognize, but you have to have the maturity to say, this doesn't really fit what I'm looking for. I'm going to watch it. I'm going to observe it and study it for experience sake, but this doesn't mean I have to push the button and go into a trade. That's maturity. That's responsibility. That's self-control.